Morning and welcome back, everyone, to our Monday Trade Ideas webinar session. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. Now, today we're going to be covering what our views are with the overall market from a macro perspective, and then walk you through our trade ideas here for the week. Now, for those of you that received the report here this morning, you might have noticed some changes, and these changes are largely to address some feedback that we've recently gotten with regards to these reports and these webinar sessions to try to make them a little bit more streamlined for your Monday morning so that we really try to get to the point with regards to what our views are from a macro perspective and then dive into our individual trade ideas. So let us know your overall feedback after today's session as far as what you think about the overall changes. But to kind of take a look at where we currently stand with the broader markets here, we had the job reports come out here on Friday that were slightly better than expected, but we also saw revisions here in previous months that actually made the labor market a little bit softer here than what we thought it was going to be from the last couple of weeks. Going to this week, probably the biggest news event, or rather headline, that we're all paying attention to right now is the fact that the fact that U.S. and China are back in the negotiation tables with regard to the trade war. Arguably, the most important negotiations with regards to everything that we've talked about with regards to trade negotiations right now, with the VIX below 17%. From my perspective, this is the market kind of being a little bit complacent, certainly optimistic, but being potentially at the same time a little bit complacent about the downside risks that we currently see here with the broader markets. There's a few things that for me, I think are really important. Obviously, the trade negotiations and how those play out will have a pretty large impact in terms of how market sentiment will play out here. But also, if you look at bond auctions, the last couple of bond auctions, especially longer dated bond auctions, were really kind of the spikes that we've seen, small spikes in volatility. And these spikes are part of a bigger narrative that we've clearly started to see here with regards to how investors are viewing the size of the US debt pile and the unsustainability of that in the long run. We saw the downgrade by Moody's that drove market sentiment fairly negatively. We saw the poor auctions in the in the treasury auctions that drove volatility. We have another 30-year bond auction here this Thursday and another one on Monday of next week. So 20 and 30-year bond auctions this Thursday and next Monday. Those are two really important events that I think we need to be paying attention to as investors as to how well those auctions go. If we continue to see those auctions struggle in terms of the number of bids to cover ratio, that's really something that I think is going to be important for investors to pay attention to. And the VIX below 17%, for me, reflects a market that is largely shrugging off that risk. And that provides an opportunity for options traders, specifically with regards to hedging tail risk, or whether you are looking at buying upside calls in VIX or buying downside puts in SPY or in any equity index. Those are opportunities to take advantage of the relatively low VIX if you also agree with me with regards to these overall risks that we see here with the treasury market. I think with the S&P 500 now within 2.5% of the all-time highs, one of the most notable things that I think we should be paying attention to is how much the 10-year yield moved last Friday. We see the 10-year yield back above 4.5%. We had a big move on Friday as the equity markets continue to grind higher here. So the equity markets kind of are still optimistic about AI with regards to NVIDIA's earnings announcement and just the overall resilience, if you will, of the overall U.S. economy, and that's kind of what the equity markets are trading off of. But at the same time, the bond market has been telling us, for quite a few weeks now that not all things are well. And those two things have to come at a head. And the question is, which one's more important? And I would argue $36 trillion of treasury debt is always going to outweigh any benefits, if you will, at the moment of what AI can potentially provide. So while short-term equities are still cautiously optimistic about the resilience of the U.S. economy and what the future outlook of of industries such as technology is going to have on the overall US economy, that's all and well. I think we really still need to be paying attention to here the treasury markets here at the moment. So, going to this week, you have the trade talks in London that I think are really important to pay attention to. We have a couple of minor economic news announcements coming out here this week. And then you also have a couple of earnings announcements we'll just talk about in our earnings navigator alongside with Apple's developer conference coming out this week. So those are the things that we're going to be paying attention to here this week. And let's take a look at the overall charts and see where we currently stand. So if you look at the S&P 500, like I said, we're within 2.5% of the all-time highs. So that's really kind of our immediate base case in terms of upside targets here. I do want to point out here recently, as we started to grind higher and made a higher high, we started to see some exhaustion here from buyers. So momentum is no longer making higher highs. That adds to a higher chance of a short-term pullback here in the equity markets. We don't see a lot of support here up until the 530 level here to the downside on the S&P 500. So if you think about it, we're within 2.5% of the all-time highs. Our downside risk is certainly, in my opinion, at the moment, larger than the upside potential here. So the risk to reward at this point skews a little bit more here to the bearish side. So, whether you are an investor and you want to start thinking about taking some profits here, if you have some short-term long positions, especially if you were a swing trader and you were a buyer here of this move, this move here is starting to look quite stretched here, and they're starting to see some signs of exhaustion here. So those are some signs that I think are really important for those of you that are swing traders to be aware of. You see it on the S&P 500, you see it on the Qs, you see it on IWM, higher highs in IWM. IWM did manage to recently just finally break out above this 210 resistance level that we've been talking about here, but this breakout here has been coupled with some negative divergence, so signs of exhaustion here. And then RSP, equal weight S&P 500. Notice that how it still has failed to break out here above this 180 level, which really shows that, as the S&P, the NASDAQ, and the Russell 2000 breaks out to new recent highs, the participation on that isn't particularly strong. And that's another sign that this equity rally is starting to see some signs of exhaustion here. Doesn't mean that we're going to pull back or sell off here necessarily, but these are just some of the things that, especially if you're a swing trader and you were buying some of those lows back in early April, this rally is starting to get a little stretched here. Now, what's interesting is the bond market. The bond market is kind of giving us a little bit of cross signals here as well. You have high yield corporate bonds that have continued to rally here. So from a credit risk perspective, credit investors are not particularly concerned about the credit risk from corporate bonds, meaning that they believe that right now balance sheets across the board from a corporate perspective remains relatively healthy. The concerns around corporations and their ability to pay off their debt is not really seen right now. So which gives us kind of a continued risk on signal here for equities. But at the same time, treasuries continue to sell off here, right? So we saw Friday sell off here. We saw the Friday sell off here in TLT as equity markets rallied here. It was a pretty significant sell-off from my perspective because you saw the 10-year yields back above 4.5%. You have both the 20 and 30-year, basically just a hair below 5% here. Basically yields at nearly 12-month highs. As equity markets reach near 12-month highs. So those two things, like I said, have to come to a head. And those are some of the things that I think at the moment, as if you're an investor in the markets right now, those are the two things you really need to be paying attention to at the moment. Okay, so then taking a look at our trade ideas here for the week. So we removed quite a few of our bullish ideas from the bullish side because of the market dynamics that I've just laid out here. With regards to volatility being as low as it is, there's not a lot of premium in terms of option selling. I also wouldn't advocate buying options at the moment, meaning being long debit spreads or long calls in this type of market environment where the risk reward is so, number one, skewed to the downside and where the upside potential here is also fairly limited. What I'm advocating more so is to take a better look here at some of the bearish opportunities here as well, while maintaining, bullish positions in some of our most highest conviction names on the bullish side. So we'll walk through some of our bullish views here on the bullish side. We've removed some of our lower conviction bullish views from the trade a bullish list and added Walmart here to our bearish list for today. So we'll walk you through that very quickly. So let's take a look at kind of our higher conviction bullish ideas here at the moment. The first one I want to take a look at here is Adobe. And, we've been on and off Adobe for quite some time here over the last year or so. But the recent sell-off here was another reason for us to take a look at being long Adobe. And so far, this has been a pretty good setup here so far. Essentially, what we're looking for is a kind of a bottoming formation here, and that's exactly what we got here is a bottoming formation around that $400 level here. You have this breakdown here below 400. You spent quite some time below 400, and it finally broke out here above 400, retested as resistance, and we're looking for that continuation here to the upside. And Adobe is one of the few companies that really has that actually has an AI product. There was a lot of concern here. I would say that the sell-off that we've seen here in Adobe over the past year has largely been on the back of investors' concern that Adobe was going to be disrupted by AI. Arguably, if you were if you look at the landscape 2 years ago, if you were trained as a creative designer and your entire workflow was done through Adobe, whether it's Photoshop or any of their video editing suites, we found that AI was largely going to replace a lot of that work here very quickly. So there was a lot of concern that all these careers and these industries were going to be disrupted by AI that Adobe, effectively sells into. However, I think what we found is kind of the sort of opposite than what we've seen here, because, Adobe has really been an early adopter of AI, and they've now kind of built a lot of these AI tools that a lot of investors were concerned was going to disrupt the company into their workflows. And if you look at kind of, the enterprise agreements that Adobe has, largely those have either stayed or they've actually grown as a result of AI. So this is really where I continue to believe in the overall long-term story for Adobe. If you look at this stock that's trading at a pretty heavy discount relative to the industry, 20 times forward earnings versus 27 for the industry, growth rates are very much in line with the industry. But really what I think is most attractive here about the company is that it's 30% net margins versus the industry is around 10, right? There are not a lot of tech companies that have net margins in the 30% range. We're really talking about Microsoft. Microsoft and Meta are really two of the only ones that I can think of off the top of my head within the Mag 7 that are, above 30% with the exception of NVIDIA. So trading at only 20 times forward earnings is by far the cheapest of any of those particular companies. So when you look at growth rates that are basically in line with the industry, you see net margins north of 30%, trading at 20 times forward earnings is incredibly cheap here. And if you look at kind of, if it were to trade closer to that 27 times forward earnings, which would be and still, in my opinion, still relatively inexpensive given how strong their net margins are, we're still talking about a $550 stock price, if it were to trade back towards industry valuations, which is around 550. That's where it was trading at back in December of this year. And that is kind of my upside target here, my conservative upside target here for Adobe. So trading at 416, I think there's substantial upside here, especially if you are looking for themes within the AI narrative. Adobe is one that I think is worth paying attention to. Okay, so let's take a look at the next one, Schwab. So Schwab recently broke out here above this, call it 82.5 level here. The stock has been trading in a range between, call it 67 or so and 82 or so for the better part of 6 months. Recently just broke out here. Not only did it break out, it also broke out while outperforming the S&P 500. So this is one that we just, after breaking out, has consolidated. We think there's further upside here for Schwab. If you look at the fundamentals here, trading at 20 times versus nearly 25 times for the industry reflects a pretty sizable discount in terms of the valuations. And then if you look at growth expectations, it far exceeds the industry in terms of what analysts are expecting EPS and revenue to grow by, head and shoulders above the industry. And then more importantly, net margins at 31% versus net margins of only 21% for the industry. So the fact that it trades at that heavy discount relative to the industry is really what provides the upside potential here. So Schwab, technically, strong breakout here as it outperformed. That shows me that there's some level of institutional accumulation here on this breakout here. And if you look at the business, I think it's clear as to why the valuations look fairly attractive here on the recent breakout here. That still suggests that there's further upside to go with a name like Charles Schwab. The next one we'll take a look at is Micron. Now, for those of you that are interested in investing in AI or within semiconductors, there are obvious names there such as NVIDIA, and arguably NVIDIA, even though I still think is relatively cheap, is starting to get a little bit more expensive, especially relative to where it was trading at just a couple of months ago. It was trading at 25, 26 times forward earnings. Now we're trading closer to 32, 33. You're really getting up there here, even though given kind of their underlying metrics, I would argue is still cheap, is not necessarily cheap overall, right? But if you look at Micron, right, because you have NVIDIA GPUs that are used in these this AI training and AI inference, the two parts of the AI infrastructure required to power kind of this whole new industry. But if you look at kind of the components of those NVIDIA GPUs, a lot of it is the internal memory of those graphics cards. And there are three primary manufacturers of the memory that goes into those graphic cards. You have HY in Korea, you have Samsung, and then you have Micron here in the United States. So Micron is one of the ways that you can potentially invest in the scaling of AI infrastructure, which at this point is pretty clear. We're very much in the infancy of kind of the build out of AI infrastructure required to power kind of the whole new wave of AI, of the AI industry, if you will. And at the core of it are obviously NVIDIA GPU chips, but within those NVIDIA GPU chips, the memory chips that are powering those GPU chips are created by companies like Micron. And in terms of US investable public companies, Micron is one of the largest that produces the memory for those specific chips. And if you look at Micron, it's trading at about 9 times forward earnings, which is a very significant discount to the industry. Now, I will say memory is a little different from just the overall semiconductor industry. So it's not exactly fair to compare, 9 times forward earnings or nearly 10 times forward earnings with the 22 that the overall semiconductor industry trades at, because generally speaking, memory based companies do trade at a lower PE. So, it's the discount valuation is not as big as perhaps it looks on the surface. But if you look at growth expectations, substantial higher expectations in terms of EPS and revenue growth. And I would argue the more important number here is the revenue growth, 22% versus about 10% for the industry, and net margins around 15% versus 10% for the industry. Now, I do think that you have to compare this against other memory semiconductor companies, not just the overall semiconductor industry. I think for those of you that do want to do a deeper dive, that's kind of where you really have to take some thoughts with regards to this. So keep in mind that when you're thinking about this from an investment perspective, and Micron, if you can see, has really been kind of trending lower here and has recently just broken out here. And that's what we like from a technical perspective. We were looking at this even earlier. We were basically looking at this as soon as it broke out above 85, and that's when we started adding to this position. But now that we've kind of broken out above this lower trend line here, again, this has another kind of technical signal, if you will, to get behind the break that we're starting to see. So Micron is outperforming the market. It's outperforming the market. It's broken out above, what we consider resistance levels twice down the last few weeks. And if you look at the valuations, they look incredibly compelling. And it's another way to get on kind of the AI semiconductor investment theme without necessarily investing in just NVIDIA, which I'm sure many of you that are interested in stocks like this are probably already invested in NVIDIA. And also, if you think about the valuations of NVIDIA, it's starting to get up there here. So I think this is really where I think Micron is another way to look at this particular industry from a different perspective. So those are kind of at the moment the remaining high conviction bullish views that we have here from the broader markets. Now let's take a look at some of our bearish views, and I'll start with one that we're adding to the list for today, which is Walmart. Walmart, we know that Walmart is definitely at one of the major what's the right term? Is a company that is going to be heavily influenced by the outcome of the US-China trade negotiations. And the one thing that I do want to always remind investors of these kind of big box retailers, especially if you look at kind of the ones that are in the grocery space, these companies will operate on razor thin margins. There's not a lot of wiggle room here with these types of companies to absorb higher input costs and not necessarily pass it on to the consumer. At the same time, we know that consumers are getting a lot more selective about their spending. We've seen kind of a significant pullback in terms of consumer spending in certain discretionary areas. Arguably, Walmart is more defensive than most other retailers, but we have seen an overall slowdown in terms of consumer spending. So companies that operate on razor thin margins like Walmart are very susceptible to downside risk, in my opinion, going forward. So if you look at the chart here, the stock, it broke out here above 100, but very quickly came back. And since then, it's retested this 100 level a couple of times. And each time it's been rejected, right? And basically, we got it rejected again here in the middle of last week. So this is really one where it's starting to look a little bit toppy here. And that's really where I think there's some potential downside risks. And if you look at the valuations, Walmart trades at a valuation that's nearly double the industry. So the industry is around 18. This is trading at 38, 37 times forward earnings. So, very much up there with like Costco, if you will, with regards to valuations. Yet, if you look at growth expectations, they're not any higher than the industry. They're actually slightly lower, but I would argue that these are largely in line with the industry. And net margins here, really not any higher than the industry, just a few basis points higher. But regardless, we're talking about net margins that are razor thin. There's not a lot of wiggle room in a lot of these companies to navigate, a complex trade war, and not have to pass on any changes on, higher input costs onto the consumer. Yet at the same time, we know consumers are incredibly sensitive in terms of consumer spending. So this is really where I see some downside risks. And I think the risk to reward looks far more favorable in terms of risk to reward to the downside, because what I mean by that, my downside target immediately is 91. My downside target below that is closer to around 85. You look at the risk to reward of these downside targets versus how far would Walmart have to go back higher before I would say, you know what, I was wrong on this trade. Let's get out of this trade at a small loss. My downside risk here is about $4 or so, right? It doesn't take much for this to get back above 100, back towards recent highs, above the recent high, and for me to say, hey, my timing on this was not correct. So I'm risking, let's call it $4 or $5 to the upside, and then look at how much downside I have in terms of potential reward. Just to the first downside target, I'm looking about $7 in terms of first downside target. My second downside target is closer to around $12, $13, right? So I'm conservatively getting about a 2-to-1 risk to reward, 3-to-1 risk to reward on these two trades, and that's why I think at this moment, given the valuations, given the kind of the macroeconomic picture, and just the overall macro environment that we've been where the S&P 500 has rallied 25% in just less than 2 months. The risk to reward, in my opinion, starts to look a little bit more favorable here to the downside. And I think Walmart represents one of the companies at the forefront of that specific intersection of all those things that I just referenced. Let's look at international paper. This is another one that we've been looking at here for quite some time here. The international paper here, this stock has kind of been trending lower here. It's been continuing to break below support, getting rejected at resistance, and it just continues to trend lower here to the downside. Trend has continued to move lower to the downside. And our downside target here is around $40 here to the downside, and just overall paper in general. um, we continue to move towards a digital world. Paper is becoming a little bit less relevant overall. Granted, paper is on a lot of different things, including like food takeouts and stuff like that. So it's not just paper from a printing perspective, but we are moving to a much more digital world in the long run, and paper is just less and less relevant in certain industries. So if you look at the company, it's trading at around 22 times forward earnings versus the industry is around 13.5. So just on that alone, you're talking about a valuation that's substantially higher than the industry. Now, it is expected to grow much faster here. So this is one thing that is going for international paper, and that's part of why I think it is trading at such high valuation is the relatively high expected growth rates. But the one thing that I think we need to be paying attention to is the fact that IP has very thin net margins, net margins under 2%. So this is really some of the things that we need to be paying attention to here right now. And with the relatively high valuation and low net margins, I see some substantial downside risk with this particular company, especially if they were to remove any guidance or their guidance starts to slow down a little bit. That's really where, these are the types of names that tumble very quickly if they start to remove some guidance. Like, for example, Lululemon's a good example of this. And they just reported earnings last Thursday. They gave a lower guidance than expected. The stock tumbled 23% in one single day. So that's just an example of the type of stocks that will likely tumble very quickly if earnings expectations or forward guidance is not met. And I think international paper is the type of company that would be at the forefront of that. Apple. Notice how as the tech industry and overall markets have recovered, Apple has not recovered here at all. They do have the developer conference here this week. Hopefully that provides a little bit of excitement for Apple investors, but I think the picture is pretty clear with regards to the overall trend that Apple's going in, which is not in the right direction. And I think I've been very vocal about this for the past year plus, which is the fact that Apple as a company has really fallen back from an innovation perspective. The iPhones are simply not selling as well. Each upgrade cycle is becoming less and less incrementally innovative, and they really have fumbled the whole AI rollout. We were expecting to see that with the iPhone 16. Now we're expecting the iPhone 17 to not have a lot of the core features that they marketed the iPhone 16 with, and then failed on the launch of it. They invested over $100 billion into Vision Pro, and that largely has not been successful. And you could argue that down the line that the software can be reused in better hardware. But at the moment, that does not seem to be an investable outlook at the moment, especially with Meta, Snapchat, and other companies kind of eating their lunch within the AR space. This is one that Apple is also quite a bit behind on with regards to kind of the future outlook. They might be right in terms of the direction of the market and that they have a stake in it, but at the moment they are not a leader in that particular space. Not that they have to be a leader in order to be successful. They weren't a leader in terms of the smartphone industry, and they now dominate it. So it's not fair to say that Apple won't dominate this in the future, but at the moment that's not the case. And that is really one of the reasons why I think it's really hard to justify Apple trading even at 26 times forward earnings, especially if you look at growth expectations. These two growth expectations continue to tumble over the last few quarters. When I started talking about I felt that Apple was overvalued at 30 times forward earnings, we were expecting EPS growth in the 12-13% range, revenue growth is around 8-9% range. And each quarter that I've been kind of bearish on Apple, we've continued to see expectations decline with both top and bottom line. The only thing that hasn't declined here really in the last few quarters are its net margins. Net margins have remained around that 25, 24%. And that is the only thing justifying a relatively high valuation for Apple. But like I said, as growth expectations continue to slow down, even it's going to be harder for them to continue to protect those net margins. And that's really where I continue to see further erosion here for the valuations here for Apple. And that's why I maintain a bearish view here on Apple. And basically any rallies are opportunities to sell into. I wouldn't quite call it the current move here a rally here, but from a technical perspective, we are starting to get to levels. I would say as you get closer around to that 210 level, those are another opportunity to basically add to a short position here for Apple. And lastly, I'll leave you with is T-Mobile. T-Mobile, very similar to Apple in terms of a chart, recently has continued to decline here. And basically any rallies are opportunities to sell. And we actually just generated a sell signal here over the weekend here for T-Mobile. Basically, what we're looking for are rallies within a overall downtrend. And that's exactly what we've seen here so far. And T-Mobile, as you can see, trades at 23 times forward earnings versus the industry average is just around a little under 11 times. So you're talking about a valuation that's more than double the industry valuation. Yet, if you look at expectations, yes, growth expectations are a little bit higher than the industry, but net margins are really not any higher. And from my perspective, when net margins are very close to the industry valuations or industry medians, a valuation that's double the industry does not make a lot of sense. T-Mobile has a lot going for it, right? It certainly is a very different company compared to AT&T and Verizon. It continues to add subscribers faster than AT&T and Verizon, but those gains are starting to slow down here as well. And that's really where the valuation that T-Mobile has commanded over the last couple of years is starting to be at risk here, and we're starting to see some of that here in the price, in the share price over the last few months. And I think this reflects, an opportunity to add some bearish exposure here to T-Mobile. So with that concludes our trade ideas here for the week. On the earnings announcement side, there's really, very little left here for the earnings season as we come in for a close. We're actually about to kick off a new earnings season in just a few weeks. At the moment, really, you have Oracle and Adobe that report this week that I think are worth paying attention to. And actually, both Oracle and Adobe made it onto our earnings navigator. Our earnings navigator is basically when we look at any stock that is highly liquid that's reporting for this week that also aligns with both our technicals and fundamentals. So, for example, both Oracle and Adobe are either outperforming the S&P 500 or starting to improve its relative strength. Those are things that we'd like to see going into an earnings announcement, because that represents some signs of potential institutional accumulation going into that earnings announcement. We also want to see valuations that we think are fairly attractive, because when you have an attractive valuation, that's really when you have the opportunity to have a relatively big move on earnings. So our earnings navigator is trying to identify stocks that we believe can make a big move on earnings. And not only we're identifying that, we're also identifying in which specific direction. So Oracle and Adobe are the two this week that meet both of our criteria from a technical and fundamental perspective that have a sizable expected move, both of them around 6.5 to 7% here in terms of the expected move for Oracle and Adobe. So with that covers what I wanted to share with you here today. Like I said, this week is relatively light on the economic calendar. We have just basically CPI coming out on Wednesday that I think are worth paying attention to. The other thing that I do think, is something that most investors are overlooking is the 30-year bond auction here on Thursday. The last bond auction was the kind of blip on the radar with regards to volatility. I think if we continue to see bond auctions that are coming in poor, investors are going to start paying more and more attention. And I think this is one that is worth paying attention to here right now. So you have one coming up on Thursday. You have another 20-year bond auction coming up on Monday of next week. Those are two that need to be on your radar for this week. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.